So let's begin with the United States. What is driving recovery? House prices have fallen to sustainable levels, a remarkable contrast to what happened in Japan. That's underpinning a recovery in the housing market. The banks, as we heard earlier, are recapitalized and healthy. And company finances are strong, some of the highest level of cash for 50 years. What's more, the fiscal tightening that took place at the beginning of the year is now behind us. All of these put the US economy in a strong position. What's the Fed doing? We heard a lot from Mr. Bernanke last night. He told us he will start reducing quantitative easing quite soon, before the end of this year, and will eliminate it by the middle of next year. After that, as unemployment falls to the crucial 6.5% level, he'll start raising interest rates. All of that sounds quite tough, but remember, monetary policy is more expansionary than it has ever been in history. And even when he starts raising rates, he's starting from a level of 0, unprecedentedly low, and he's doing it with a banking system that is back in health. The effect of Mr. Bernanke's announcements yesterday and over the last several weeks, I would liken to shaking a tree to get rid of the dead leaves. And by that, I mean some of the crazy overvaluation in parts of the financial markets, like a CCC issue at just over 6% only 2 months ago. The effect of all of this has been to push up interest rates on longer dated bonds, trading the 10-year trading at 2.4% this morning. I regard that as a much healthier level, provided it doesn't go a lot higher too quickly. I think the economy can withstand that. By the way, if we look back to history, the red line is the date when the Fed starts tightening, and the blue line is the progress of the equity market. This is the average over the past 5 cycles. And you can see that for a period of 9 months before and 9 months after, the equity markets actually trend upwards. And they do that because the adverse effect of higher interest rates is more than offset by the improving economy, which benefits the stock market and is the very reason why the Fed is tightening. All right, let's move on and look at China. I find it helpful to take a 40, 50-year perspective back to when modern China emerged from the Cultural Revolution in the 1970s. Roughly speaking, China has seen rapid periods of growth followed by slowdown on cycles typically of 10 to 12 years. When a slowdown happens, yes, as we heard earlier, you sometimes get a liquidity injection, but more fundamentally, you get a major change of structural policy. In 2001, it was joining the WTO, the World Trade Organization, and boosting exports. Right now, it's all about boosting the service sector. For example, reducing the tax burden on services. Services are already just equal to industry, and that trend will continue big time in the next 5 to 10 years. That's partly about becoming a more modern tertiary economy. It's also good politics because this is about basic healthcare, financial, entertainment services for low and lower middle income people. But as I remarked, this has major effects on suppliers of raw materials to China, like Brazil, Chile, South Africa, Indonesia. They have to adapt to a less friendly environment for basic commodities, and that creates problems in their economies. No wonder emerging market equities are underperforming against the developed markets in a major way. What about the Eurozone? Well, we all know that Mr. Draghi put the safety net, the outright monetary transactions, in which he promised unlimited buying of short-dated government bonds in return for a country accepting that Brussels, or should I say Mrs. Merkel, dictated their fiscal policy. No one has yet taken up that option. They haven't needed to, because as we know, the bond yields, the bond spreads have come right down just with the threat of Mr. Draghi's action. Even the recent sell-off doesn't alter that picture. But it's not just about Mr. Draghi. There is improvement on the ground. There's a checklist. As you can see, Italy does, I'm afraid, look a bit lagging compared to some of the others. But there is also genuine reduction in the imbalances. We saw a minute ago how the US housing market had seen prices fall to realistic levels at which housing activity could revive. The same is beginning to happen in Europe, in Greece, in Ireland, and Spain still has some way to go, but it's come a long way. It's maybe got another 6 to 12 months of agony before prices get to that sensible level where recovery can begin. Another crucial point is that the current account deficits have been eliminated. Italy was never as bad as the others. At the worst, it was about 4% of GDP. Spain got to 10%, Portugal about 12%, Greece about 17%. Now they are all, give or take, at a zero balance. And that means they are no longer reliant on external finance. Even without Mr. Draghi, this helps to make the situation much more stable. Of course, it's been bought at the cost of deep recession cutting imports. But something else is going on as well. It's the so-called internal devaluation. A lot of people outside Europe thought the euro had to break up in order to deal with this divergence in unit labour costs. But there was another solution. That was for German labour costs to edge upwards, which they're doing because the German labour market is so hot, and for labour costs in other countries to come down, partly through lower wages, partly through better productivity. The progress in Greece and Spain is already remarkable. Italy, of course, still has homework to do. So, the Eurozone, I think, set for a bottoming out this year and a slow recovery into next year as those various economic imbalances continue to decline and lay the basis for recovery. In my view, the biggest single disruptive threat ahead remains the German elections. We'll have to see what happens there. Now, I've got a section on inflation risks, and I've got that because the central bank action has made many people worried about inflation. But here I do have to disagree with the previous speaker. I actually think there is no inflation threat in the near term, not in the next 2 to 3 years. And the reason for that is because I believe there is still a lot of spare capacity in America, in Europe, and other developed countries. Spare capacity in factories, in services, and in the labour market. In two or 3 years' time, that margin will have been reduced, and then there can be an inflation threat. And in many ways, I welcome the fact that Mr. Bernanke is moving now to gradually withdraw the monetary stimulus, because it reduces the risk that this inflation threat gets real in 2 or 3 years' time. So where are we in the financial markets? Well, let me just try and summarize for you where I think we are in stock markets. And to do that, I'm going to use this chart of the US stock market going back 160 years to 1849. Of course, the market was rather different in those days, but still, this gives us a great historic perspective. And this chart shows the total return, that's capital gain plus reinvested dividends minus the inflation rate. And it's all shown on a log scale. By the way, the trend is 6.2% a year. That's pretty impressive. It meant that in the long term, if you invested in US stocks, you beat inflation by more than 6%. I'm afraid other stock markets, and Credit Suisse has a detailed book on this if you're interested, with data almost as long. I'm afraid other stock markets didn't do as well. 3 or 4% is typical, and some are worse than that. Now, look at some of the action relatively recently. That peak there is the peak of the dot-com bubble. And what this chart shows you is that that bubble took equity prices more or less as high as they've ever been above the trend line. And when we crashed back, we did not go below the trend. we just got back onto the trend. In other words, the imbalance was, as it were, still there. By the time we got to the Lehman crisis, we were once again significantly above trend. But this time, the crash took us way below the trend. In fact, almost, not quite, not compared to the Great Crash, but compared to many events, as far below as we've ever been. And the bull market in equities since then has simply restored us on to the long-term trend line. So for those who feel that the stock markets have already gone up a long, long way, I think this chart gives a good perspective. Of course, there's no guarantee that you will, from here, move above the trend line or even along it. But I would comment that by construction, you spend as much time above this line as you do below. And I'd also add that most other valuation metrics, with just one notable exception, do suggest that equities are either fair value or cheap at the moment. I won't go into detail by different regions, although I'm happy to answer Q&A on that, but I will just draw attention to the emerging markets here. Remember what I commented earlier, that emerging markets really are running into structural problems because they no longer have that extra strong demand for raw materials out of China. Now, the picture's actually more complex than that, because every emerging market has a bit of a different story in terms of how many commodities it exports or imports, as well as how much debt and deficit it's got. What I think we can say is that a country like Brazil or Chile or Indonesia, as I mentioned at the beginning, are major exporters of raw materials, so they face quite big headwinds here. A country like Turkey does not export raw materials, but it has a large current account deficit. So it faces a headwind as liquidity gets tighter, courtesy of Mr. Bernanke. But some other countries like Mexico don't suffer from these problems, and indeed Mexico is very nicely exposed to the coming recovery in the United States. And a country like Taiwan or Korea benefit as well, because they specialize in information technology. In short, it's a very diverse picture. And I think that's very useful when one is looking at which markets will grow more strongly, although as stock market investors, I think we should be aware, or indeed debt investors, that much of what I've said, perhaps not all, but much of it is already priced in to relative valuations. Let me finish with a couple of words on gold. Why did gold go up so much, and why has it fallen so much, and where will it go? It went up partly because real interest rates got so negative. On this chart, the grey line is the gold price, and the blue line is the real interest rate on US government inflation-linked bonds, but plotted on an inverse scale. So when the blue line goes up, real interest rates are getting lower and indeed going negative. Well, the gold price went up, so far as we can tell, because real interest rates got lower and then went negative, and that takes away the penalty that you pay when you buy gold, because on gold you don't get any interest. But if you're getting a negative interest rate on your financial savings, you might as well buy gold. especially in an environment where you're worried about the euro breaking up and financial crisis. Well, what's happened now is that both those supports for gold have reversed. Courtesy of what Mr. Bernanke is doing, the real interest rates are now rising again, and courtesy of what Mr. Draghi did, as well as the homework on the ground in countries around Europe, the risk of a Eurozone breakup, the risk of a financial crisis is much less. All of that removes the reason for buying gold. Gold yesterday or overnight has traded below $1,300 for the first time in this cycle, and our colleagues who do technical analysis tell us that this was an important support point, and if this is convincingly broken, it could well drop another $100, $200 in price in coming months. So, ladies and gentlemen, I've got many more charts, as you can see. We could talk about euro-dollar, which I would see correcting now from the recent highs, but not collapsing, perhaps falling to around 1.27, 1.25, certainly not to the 1.15 that some people talk about. And there are many other things we can talk about, but I think I'm going to draw to a close so as to leave sort of questions open to you. I think I will just show you this final chart of our top investment ideas. In fixed income, focusing on credit rather than duration. In equities, focusing on recovery stocks. The dividend theme is still of interest. And looking at some real estate opportunities around the world. So, ladies and gentlemen, let me bring it to a halt there and invite some Q&A.